I got paid $150,000 to buy this $650,000 house. Now, I know it sounds crazy, but let me explain. I originally purchased this house. It was my first home I ever purchased, and I bought it for $645,650K. Now, I originally did a house hack where I bought it from my own place, lived in it, and then when I could legally, I then turned it into a short-term Airbnb. Now, the minute I turned it into a short-term Airbnb, it allowed me to do what's called a cost segregation study. It's a huge tax strategy. It is one of the most OP things you could possibly do. If you look at any of the world's like wealthiest guys who do real estate, Grant Cardone, all these big real estate guys, everyone preaches real estate because it's awesome, yes, but also tax benefits. And that's exactly what a cost segregation study can do for you. It can save you a shit ton on taxes. Essentially, what a cost segregation study is, if you have a short-term rental, it's a business, average stays are less than 7 days, you can then do a cost segregation study. And essentially, a study allows me to pay someone to come look at my house and basically accelerate the depreciation of this home over the next 30 years and use all of the depreciation that I'm gonna have to do to that house and capture that in 1 year as a loss. So I'm gonna kind of dumb that down for you guys. I didn't want to disturb my guests, so we're gonna bounce. Now, let me kind of explain. So that house, right, it is a business, it is an operating business. And so you're going to have on that property, and the government and the IRS knows this, you're gonna have to fix stuff. You're gonna have to fix the fridge. You might have to fix cracks in the driveway. You might have to, fix whatever it is. Again, these are rough numbers, but I'll give you an example. Let's say that house behind me I bought, I could deduct $8,000 a year from it for depreciation and all this stuff. Instead of having to do that $8,000 year over year over year, I can now multiply that for the entire 27 and a half years that I would be eligible to do that deduction from and capture all of that in 1 year. For example, what's 27 and a half times 8,000? These are rough numbers, but that's roughly $215,000. And now, because I've captured all of that depreciation in 1 year and not split it up year over year over year, I can now go and write that $216,000 off my actual income. And the reason I can do that, there's a couple key important things here, is because I've spent over 500 hours on my properties, managing it, putting furniture in it, furnishing it, dealing with repairs, all that stuff. And so if you spend enough time on the house, you can now use that entire write-off to deduct from your income. So to kind of really tie this in and really dumb things down here, let's say I made $500,000 last year. With this property, I did a cost segregation study on it and I got a $215,000 write-off of accelerated depreciation. I can now go on my taxes, instead of my taxable income being $500,000, now my new income would only be $285,000. So depending on your tax bracket there, you're saving a substantial amount of money. And this is one of the key reasons of why this strategy and this tax thing is so good. So now there's one thing to really consider here, and that's really important to understand. If you're going to go buy a house strictly for the tax benefits of this house, you need to be really careful where you buy it, because you cannot write off or depreciate the land basis of the home. You can only depreciate the actual bones and structure and physical being of the house. So everything above the ground, because the dirt is dirt. It's not going to depreciate, right? You can't replace the dirt or fix the dirt or remodel the dirt. So the land basis is something that's very important. Now, I'll break it down very simply. A piece of land on, let's say, the island of Oahu in Hawaii, where I used to live, that is going to be exponentially more expensive than a piece of land or plot of land in, let's say, rural Iowa. No shade, but it's just the truth. Let's say you bought a $2 million home on the island of Oahu. The land basis of that $2 million purchase price is probably going to be close to half, if not more. Obviously, that's a rough number, but let's just say it's half, right? So that $2 million home you just bought, $1 million of that was just paying for the lot. Let's say you go buy a $2 million home in the backwoods of Iowa, maybe 1.8 million of that is most likely going to be used for the actual materials and stuff of the house. So if I was going to turn that into an Airbnb and I was doing a cost segregation study, I'm going to get way more depreciation on that home in Iowa than I am on that home in Hawaii, because I can't depreciate the dirt, the land. I can only depreciate everything above ground. And so that's something really important to take into consideration when you're going to be doing a cost segregation study. So keep that in mind. Another great reason of why cost segregation studies are so awesome. If you are an investor in real estate, you guys know how important DTI is. DTI stands for debt to income ratio. It's very important. Essentially what a DTI is, it allows a bank or lender to decide how much of a loan they can give you. Let me kind of dumb this down for you. Let's say that you make $10,000 a month. and you have $1,000 car payment, and then you have a $1,000 debt to student loans or something like that. So on your tax return, that $10,000 a month you're making in the eyes of the bank is only $8,000 because you already have a $1,000 car payment and you pay $1,000 of student loans every month. Your debt to income is very important. Lenders will not let you get really more than 50% debt to income. Let's say that you have $2,000 worth of bills every month and you're only making $10,000 a month. A lender is not going to approve you to buy a home where your mortgage is going to be $3,000 because then you're way over a 50% debt to income ratio. I hope that made sense. If not, Google it. Not that complicated, but I understand if you don't get it because I might not be the best explainer. But anyway, that's why debt to incomes are so important. Now, here's what's awesome about a cost segregation study. I wrote off, let's say, again, that $215,000 of depreciation off my $500,000 income. According to the IRS, I only made $285,000. So that drastically could affect my monthly income. But what's great is lenders, when you're going to get approved for more properties or more loans, they understand that you accelerated that depreciation. So they understand that you didn't actually pay out of pocket for that. So when you're going to get approved or apply for another loan, they add that accelerated depreciation that you took off your income back into your income, and they can approve you for a higher loan. So it's literally a win-win-win all around. You get to write off all that money off your income to the government, to the IRS, so you don't have to pay all that money in taxes. But if you want to keep investing and go get more loans, that income works for you and helps you get approved for bigger, better loans. So it's literally a life hack. It's a little tricky in how you can qualify for it, but most short-term rental properties can and will work. And it is by far, in my opinion, in my young real estate career, is the best tax strategy benefit you could possibly do. And also, at the end of the day, you're buying an actual asset too. And if you're lucky, it'll cash flow you. And the great part is, you guys might be confused. Well, my house is going to appreciate in 30 years. Of course it is. Your house is 100% going to appreciate, but you can still write off the depreciation of the house. So it's a win-win-win-win-win. And so to kind of answer the question that I originally stated out in front of the house, how did I get paid $150,000 to buy that $650,000 home? Well, okay, sure, you're right. I didn't get a $150,000 check to buy it. But when I did this and I did a cost segregation study on it, I got a $150,000 write-off on my taxes, on my tax return. So I was able to claim $150,000 less of income that I didn't have to pay taxes on, which it ended up, pound for pound saving me about $65,000, $70,000 out of pocket on my tax bills. So I got to buy this house. I also got to save $70,000 that instead of paying to the tax man, I got to keep in my pocket that I can continue to go buy and invest in more property. So that is the principle of cost segregation. I know this videos might be a little advanced, a little confusing. Again, I'm not a financial advisor. I'm not a CPA. Everything I just said could be totally wrong. So take what you want at your own risk. Do your research, ask your CPA, but strategy does exist. It's very real. It's very legal, and I highly recommend it. So that's all I got for this video. I appreciate you guys. Hit the like button, subscribe. This is the year that we're taking off all finance, business, all that stuff. Not all my videos are this nerdy, but I thought I'd share this because I think it's a good strategy. So I appreciate you guys. I'll see you in the next one. Peace.